Hi, so today I'm joined by Joe Capaldi from CS Investment Managers. Welcome, Joe.
Good to be here, David.
Yeah, good to have you with us. So we're in sort of something of acronym heaven today. So we're talking about AIM. So to the uninitiated, tell us a little bit about what AIM is.
Sure. So AIM is the London's alternative investment market. So this is an area that small companies will typically go to find additional funding for further growth, be that investment in another plant or machinery or something to meet further demand. So it's got over 800 companies quoted on it at present. So it's really actually quite large in terms of the choice, as it were, for investors, and has been in existence since 1995. Now, it's really been somewhat of a success story, actually, here in the UK and in Europe as a whole. As you know, it's probably the most established market for smaller companies in this area of the globe, and one of the most established in the world. Government support has certainly helped in this area. And that's one of the things we'll be touching on today is the business property relief and how that relates to inheritance tax planning. So it's really quite a dynamic market is the picture I'd want to paint. Very different rules in some respects to the main market with your big FTSE companies, you know, your Rio Tintos, Royal Dutch Shells, etc. Because the AIM market does have lower disclosure requirements and free float requirements. Now, it doesn't prescribe a specific free float percentage, unlike the main market, where, you know, if you're a big company looking to list on the FTSE, you'll typically have to have 25% of your stock on offer at that time or more, as would typically be the case. And in addition to that, companies listing on the AIM market don't actually need to have any formal trading history. So it could be a completely new business idea, for example, that you know just happens to be attractive at that moment in time. So there are some areas of the AIM market where there's perhaps a bit more of a speculative nature. So it is one where you certainly have to be careful.
Yeah.
Something else that's actually quite different about AIM is when a company is looking to list on the AIM market, they'll effectively have to be sponsored and deemed to be suitable by a nominated advisor. And that'll typically be one of the major market makers or brokers that operate for companies on the AIM market. To give viewers an idea of the kind of companies that you know you could associate with AIM that they maybe have heard of. Fever Tree Drinks is one, so the tonic maker for the likes of, you know, your gin and tonic that you may have when we're all lucky to get down to the pub again, and probably at home at the moment.
That's been a real favourite AIM stock in recent years, hasn't it?
It certainly has been. Yes, it's been one of a bit of a darling, I'd say. Another one that people will have heard of is ASOS, the online clothing company.
Yeah.
Jet2 is another one for those of us who are looking to travel perhaps later this year. Fingers crossed with the vaccines. And there's been historic success stories which have since gone on to you know, the likes of the main list. So Domino's Pizza would be a good example of that. So that probably gives you a good flavour for AIM as a whole.
Flavour, Domino's Pizza, heard what you did there.
I didn't mean that one.
So I suppose the junior market, if you like, and less transparency probably in terms of requirements and look through. But I suppose that, you know, that's where specialist advisors and managers come in as well. So yes, that's it. It's a useful sort of useful summary and overview. So you touched on sort of some of the tax advantages. So tell us about you mentioned, I think, specifically inheritance tax advantages. So tell us a bit about that.
Yes. So AIM shares and certain other, you know, private or unquoted business interests, which, you know, you'd experience in the VCT market and things, but not the case here. Qualify for business property relief under the HMRC rules. And what that means is if you hold shares in particular AIM stocks which qualify for this relief, they'll qualify for inheritance tax relief. Now, what that effectively means is if you have, over the asset requirement that would exempt you for inheritance tax in terms of your nil and resident rate bands, you can invest the excess assets in AIM shares, and after 2 years, it will completely remove the value of that AIM portfolio from your taxable estate for the inheritance tax calculation. So rather than being hit with a 40% tax charge on death when you look to pass on those assets to beneficiaries, you'll be completely exempt from that. So in terms of the benefits of AIM, it's quite powerful from an intergenerational wealth planning perspective. One thing that's also proved to be relatively attractive in recent years is back in 2013, which seems longer ago now than it did, is that AIM shares qualified for ISAs. So in addition to IHT relief, you can now also wrap the AIM portfolio, as it were, and protect it from both capital gains tax and income tax on any dividends. It's not a market where we typically see a lot of high income stocks, but for those who want the flexibility to withdraw some income from their AIM portfolio, they certainly can do.
But yeah, as you say, the main constituents of the market are growth stocks predominantly. So
very much.
Yeah, it's an additional advantage, though. Okay.
Yes, indeed.
So we've talked about AIM, we've talked about IHT, inheritance tax. We've talked about BPR, business property relief. So all this good stuff. Tell us about the other side. Tell us about the risks.
So in terms of risks, there are a few things to be aware of. Let's have a think. So first of all, there's those lower reporting requirements. So the standards in terms of reporting are lower, so there needs to be a certain degree of greater analysis, I would say, on some of these to get comfortable with the underlying business case, as well as the fact that with AIM, certain companies don't need to demonstrate several years of profits and things like they do on the main market. So there is risk in terms of fluctuations for operational performance with some AIM companies. Many companies have been quoted on the market for years, if not a couple of decades at this point. So you can filter those out, but it is a risk if you're dealing with a new hot IPO or something. The other aspect of AIM is you are dealing with smaller companies where funding requirements can be harder to obtain if they get into a period of trouble and need additional capital to survive. Now, certainly throughout the COVID pandemic, we have seen companies generally who have had solid business cases where investors expect them to kick on once again once the market normalizes and the vaccine's rolled out. Raise additional equity with fair ease and things if they've gotten to a spot of bother. And it's certainly created attractive opportunities for those who've scoured the market. But it is another risk if there's a bit of a wobble. Larger companies on the main market tend to find it easier to raise capital.
Yeah.
And then finally, I think one of the things that you really need to bear in mind when investing in AIM is the companies are more liquid. Because you're dealing with market caps here that are in some cases, less than £100 million, relative to FTSE companies where it's several billion. If there's not a free float requirement when they list on the market in the first place, it means that only a small proportion of that company might actually change hands on any given day. And so certain filters need to be applied for those investing in the AIM market relative to the amount of money being managed to make sure that they can move in and out of the shares that they're buying and selling with ease. Now, that does mean if there's a small amount thinly traded on the market, that it can lead to some big price swings when there's substantial volumes of either buying or selling. So it can be quite jumpy in terms of the investment return profile, as opposed to a bit smoother as you'd expect with larger companies.
Yeah. And as you say, the increased volatility that you would anticipate, there's a risk return trade-off there to an extent.
There is. I mean, there's the potential for bigger drawdowns, but there's also the potential for much bigger upside in many cases.
Yeah. So yeah, as ever, it's about clients considering the diversified nature of their portfolios, and if this was an appropriate portion to be considered, it would form part of a larger piece typically.
Yes, typically, normally form part of and usually either inheritance tax or long-term growth plan.
Yeah. Okay, that's great. So you used the word typical there, and obviously there's no such thing as a typical client because everyone's an individual.
Yeah.
But if you're going to paint a general picture of the sort of client who this might be appropriate to consider.
So there's obviously those who are looking to obtain that inheritance tax on their investments after 2 years. One of the nuances I'd say with that is AIM is a bit more flexible as an investment option for that area than other options that are out there for investors. So something such as a trust would take longer to qualify for that inheritance tax relief. And there are certainly other options out there where, in terms of actually getting your hands on that capital, if you need a portion of it back, it can be challenging. With AIM, that's not the case. If a client comes to us and says, we would like to withdraw, a portion of this to meet another, lifetime spending goal or something, there's the option to do that. And in particular, because the assets are growing over time, it does give you that flexibility. So those are certainly the two sort of main areas I'd say that we see clients looking for. The other one, for those who have an investment horizon typically of 5 years or longer, we do have some, clients who come to us and say, look, we really want to grow these assets quite aggressively. Please, put some of them in an AIM portfolio for us, and that's something that we will do. Obviously, it has to meet a particular risk profile for that, but certainly it is a high growth area in the long term if you pick your stocks carefully. Yeah.
So we've covered a lot of ground there in a short time. Really, anything we haven't sort of picked up there? Do you think, Joe? Or have we covered that mostly?
I think there's probably just some of the ancillary benefits.
Oh yeah.
So one would be that AIM shares are exempt from stamp duty. So when you're buying and selling stocks on the main market, you will pay 0.5% on the value of that transaction. The other thing I would point out is that AIM has become a home for many growing leaders within the particular niche in recent years. So to give some examples, RWS, which is a patent translation company, would be a good one. If you go to the pharmacist these days and you buy medication, it will usually come with some form of leaflet inside that has a load of disclaimers and then instructions in various languages. There's a very good chance it will be RWS who've done that. Another example would be Keyword Studios, which provides outsourced testing and environmental design for the major video game studios across the world. So they've done works on games such as your Call of Duties, Fortnite, etc., which some of the younger viewers may have heard of. And then finally, I think the one thing I would probably highlight about AIM is it is very much a stock picker's market, because it is, there's over 800 companies on there. There's less broker coverage or research on them. The typical stock on the FTSE will have multiple analysts covering them, more than 10 if they're really large. on AIM, you might have only one, and in many cases, the forecasts may be wrong. So unless the businesses are actually properly researched, they might be typically temporarily misunderstood. So you'll often find there's good valuation opportunities there for shares which actually trade at a discount to their fair value. So it certainly has opportunities for investors to actually beat that market.
Cool. So I guess the watchword or the advice would be seek professional advice.
I'd certainly say so. It's not an area for the uninitiated or faint-hearted.
No, it's sound advice. Sound advice. Joe, that's been really useful today. Thank you very much for your time, Joe Capaldi from CS Investment Managers. Thanks again.
Thank you, David. Take care.